Good morning. Thank you for joining us today for Federal Reserve Vice Chair of Supervision Michelle Bowman's speech on bank capital requirements. Chair Bowman has been with the Fed on the Board of Governors since 2018, when she became the first person ever to fill the community bank seat board spot on the board. Back then, she was a very popular pick because of her background. She was not an insider, not a long-termer at the Fed, and she was not from Wall Street. And everybody knows that's evil. So, a significant part of her background was in the family business, which was banking, small community bank in Kansas, which sounds like I made that up, but that's true. She was directly involved in regulatory compliance, and then she soon moved on from there to be the Kansas State Banking Commissioner. So some might say that she was perfectly positioned to understand banking regulation and its effect on communities. Fast forward all the way to June 2025, and in her role as Vice Chair for Supervision, she undertook a comprehensive review of the bank capital framework, which some might argue was sorely needed. I might argue that too. At the end of July, at her direction, the Fed held a day-long conference to discuss the integrated review of that capital framework. It was a great conference, and it's still available online if you want to check it out. Every single panel is on there. And that's not because I was on the panel. It would have been a better conference, but I wasn't there. Since then, Chair Bowman has introduced changes to 2 of the 4 pillars, the supplementary leverage ratio and the stress testing regime. And as a next step in this comprehensive review, the Fed, along with the other bank regulatory agencies, is set now to introduce proposed changes to the risk-based capital requirements. Please join me in welcoming Vice Chair for Supervision, Michelle Bowman.
Thank you, Michael. Well, thank you very much for the opportunity to join you here at Cato today. I want to thank Anne and I want to thank Norbert for accommodating our schedule on when we were planning to get the timeline for the introduction of these proposals, and wanted to provide a preview. So this is a great opportunity to have a first event of its kind here at Cato, but also to further our opportunity to share some details on our proposal before we have a board meeting to discuss the proposal and move it forward. So good morning. It's great to be here with you at the Cato Institute as an opportunity to discuss our bank capital requirements. As we all know, capital requirements form the foundation of our prudential regulatory framework. And in the coming week, we will propose rules to implement the final phase of Basel III here in the United States. These changes to the capital framework eliminate overlapping requirements. They right-size calibrations to match actual risk, and they comprehensively address long-standing gaps in our prudential framework. The result is more efficient regulation and banks that are better positioned to support economic growth while preserving safety and soundness. Following the 2008 financial crisis, regulators implemented reforms that substantially increased bank capital and strengthened the financial system and its resilience. While these initial reforms were necessary, experience shows that requirements that overly calibrate low-risk activities produce unintended consequences. It constrains credit availability. It pushes activity into the less regulated non-bank sector, and it layers on complexity and costs without meaningfully enhancing safety and soundness. Requirements like the global systemically important bank surcharge, the GSIB surcharge, which has increased in such a way that it has become disassociated from actual risk, illustrate this problem. Continuously increasing capital levels without a specific purpose imposes real economic costs. When capital requirements become excessive, They impair the banking system's fundamental function of providing credit to the real economy. The price is paid in foregone economic growth, reduced job creation, and lower standards of living. In our work to modernize the capital framework, we evaluated changes in the aggregate while taking a bottom-up approach to ensure that the overall framework is appropriate. We did not begin by setting an aggregate target and working backward to meet it. Instead, each requirement is evaluated on its merits, examining first whether it's properly calibrated to risk, second, whether it achieves its intended purpose, and third, whether it avoids creating unintended outcomes. We have developed these proposals to modify each of the 4 pillars of our regulatory capital framework for the largest banks: stress testing, the supplementary leverage ratio, the Basel III framework for risk-based capital requirements, and the GSIB surcharge. The Federal Reserve is taking steps to modernize our capital requirements and is working together with the OCC and the FDIC to propose these joint rulemakings. The proposals take into account the aggregate impact of revisions already introduced to the ESL, and we've already introduced the ESLR, which would restore it to its original role as a backstop to risk-based capital requirements and to the stress test framework. The Federal Reserve has already proposed a number of changes to the stress testing framework and its process to eliminate or to enhance transparency and public accountability. In addition, the outstanding stress testing proposals reduce excessive volatility while providing a robust analysis of bank conditions under a hypothetical stress scenario. The proposals to address the remaining 2 pillars, Basel III and the GSIB surcharge, streamline the risk-based capital framework using a single set of calculations, improve alignment between requirements and risk, and revise the GSIB surcharge to better capture the risks of our largest and our most complex banks. We are also updating capital requirements for smaller and less complex banks. So last November, the banking agencies proposed enhancements to the community bank leverage ratio. These revisions reduce regulatory burden and increase flexibility for qualifying community banks while preserving their strong capital levels. A new standardized approach will also revise the risk-based capital requirements for non-GSIB banks. Together, these proposals will better align requirements with risk and allow banks to engage in lower risk traditional banking activities. Collectively, they reduce incentives for activities like mortgage origination, mortgage servicing, and lending to businesses to migrate outside of the regulated banking sector. Importantly, the capital framework remains robust. Under the new framework, banks maintain their capacity to absorb losses while continuing to provide credit and financial services to households and businesses across a wide range of economic conditions. So beginning with the Basel III proposal. Our Basel III proposal builds on the 2017 Basel Agreement while incorporating targeted adjustments to reflect U.S.-specific aspects of the banking and financial markets, U.S. financial markets. Finalizing these reforms will provide the industry with greater certainty for planning and for management. It will also promote broadly consistent international capital standards. An important feature of this proposal is the elimination of duplicative capital calculations for the largest banks. Today, these banks must maintain 2 sets of risk-based capital ratios, one using the standardized approach and another using internal model-based advanced approaches. Experience has shown that this duplication creates burden without providing corresponding benefits. Therefore, the proposal establishes a single approach to calculate the risk-based capital requirements for the largest banks. To better support the flow of credit to households and businesses, the revised framework improves the risk sensitivity of requirements for lending activities. The proposal recognizes loan-to-value ratios in mortgage capital requirements and reflects repayment history in retail lending. Importantly, it does not add new capital penalties for mortgages or consumer lending, and it seeks public feedback on the appropriate role of private mortgage insurance. The proposal also differentiates requirements based on the credit quality of businesses, ensuring that capital treatment is aligned with actual risk. Turning to operational risk, the new framework includes standardized requirements for operational risk, consistent with international standards, but tailored to the U.S. large banks. Activities that produce fee-based revenues and expenses, like credit cards, would have those revenues and costs accounted for on a net basis, rather than separately as in the Basel standard. Staff analysis also indicates that certain activities like wealth management and custody services have historically exhibited lower levels of operational risk, and the proposed requirements are calibrated to reflect those differences. On market risk, the proposal also strengthens capital requirements for banks' trading activities in a manner calibrated to unique U.S. capital markets. The methodology better captures losses under stress conditions, and it reflects the risk of less liquid positions. It introduces a standardized calculation that applies consistently across firms, while reducing burden for banks with simple trading activities. Relative to the Basel standard, the proposal better recognizes diversification across positions, and it extends the use of bank internal models, where data are sufficiently robust, ensuring capital requirements are commensurate with that risk. On CVA risk, the proposal also introduces a capital requirement for credit valuation adjustment, which is the risk of losses on derivative positions from counterparty credit risk. This requirement applies to banks with significant trading activity and material derivative portfolios, consistent with the international standards. Importantly, the requirement focuses on bilateral transactions among large financial firms, avoiding unintended costs for commercial end users of derivatives, including farmers and manufacturers. Stress testing and the resulting stress capital buffer complement the risk-based framework by adding granularity and risk sensitivity. However, overlaps between the stress test and the risk-based framework can produce excessive requirements for some activities. So in developing the Basel III proposal, we were mindful of these overlaps, and we evaluated the combined effect of the requirements in our impact analysis. In line with international standards and with a view toward improving risk sensitivity, the Basel III proposal increases capital requirements for operational risk and for market risk. Separately, recently proposed changes to stress testing models are expected to improve the reliability of the operational risk model and the coherence of the global market shock scenario. In doing so, it reduces requirements for operational risk and trading positions. The overall calibration of these risks should remain largely unchanged, while individual components of the framework are meaningfully improved. I'll turn now to talk about the standardized approach in that proposal. So while we're implementing Basel III requirements for large and internationally active banks, and it's been long overdue, it is equally important to update risk-based capital requirements for all of our banks. The approach leverages a similar rationale to reduce redundancy, simplify where possible, achieve better calibration of requirements relative to risk, and remove incentives for activities to migrate out of the banking system. The standardized approach proposal modifies risk-based capital calculations for most banks, improving risk alignment while preserving a simple framework. The proposed changes address critical categories of bank lending, including mortgages, consumer lending, and business lending. These changes moderately reduced requirements and align the standardized approach with a Basel III proposal. This ensures greater consistency and a level playing field among all banks. The changes better align requirements with risk, increasing efficiency, and ensure the availability of credit to households and businesses. At the same time, all U.S. banks would remain subject to robust capital standards. Both the standardized approach and the Basel III proposals remove any requirement to deduct mortgage servicing assets from regulatory capital. Instead, they assign a 250% risk weight to these assets while we seek public feedback about what the appropriate risk weight should be. This should reduce disincentives for participating in mortgage markets and servicing their mortgage originations, thereby addressing the mortgage activity migration to non-banks over the past 15 years. The standardized approach proposal also requires large banks to include elements of accumulated other comprehensive income, or AOCI, in common equity Tier 1 capital. This aligns with the treatment of those assets for the largest institutions. The proposal also invites public comment on the appropriate scope of mandatory AOCI recognition and sets a 5-year phase-in for this change to avoid a material immediate increase in capital requirements. So I'll now turn to the GSIB surcharge proposal. Under our current framework, the largest, most complex banks are subject to a GSIB surcharge, which is a capital requirement intended to mitigate the systemic risk that is posed by these institutions. This proposal strengthens and modernizes this calculation of the requirement in several ways. First, the proposal updates the parameters or the coefficients that determine the impact of firms' activities on the GSIB surcharge. This better reflects recent changes in the financial system. When the GSIB surcharge was introduced in 2015, the board committed to regularly review the surcharge coefficients. This practice would have ensured that the coefficients account for changes in price level and for economic growth. But more than 10 years later, the board has yet to complete a review. So over time, the surcharges have continued to escalate, even when the size of the largest banks has grown roughly in line with the broader economy. In addition, our surcharges have increasingly diverged from the international method for setting the GSIB surcharge. The proposal addresses this divergence by realigning our surcharge with the international method. And to ensure that the surcharges do not unintentionally increase, the proposal indexes the surcharge to economic growth going forward. These changes keep this additional capital requirement calibrated to the systemic risks of our largest, most complex banks over time. Second, the proposal revises the surcharge component that accounts for risk associated with short-term funding, which was originally intended to represent 20% of the surcharge. Instead, it represents 30%. So revising this element of the surcharge would bring it into better alignment with other elements of the calculation. And third, to reduce incentives to make year-end adjustments to balance sheets, the proposal requires GSIBs to calculate certain systemic risk indicators as an average of their daily or monthly values, rather than at year-end. Fourth, to reduce cliff effects and increase sensitivity to changes in a firm's risk profile, the proposal assigns surcharges in increments of 10 basis points rather than 50 basis points. And finally, the proposal improves the measurement of certain systemic indicators, aligning it with international standards. These adjustments reduce capital requirements. But most of the reduction comes from fulfilling the board's commitment to adjust for economic growth and correct excessive requirements associated with the short-term wholesale funding component. We expect the Basel III proposal to result in a small increase in requirements for the largest banks, similar to what is expected in the UK's proposal. The GSIB surcharge proposal results in a modest decrease in the surcharges, which addresses the recent increases in this requirement that deviated from risk. Together, these proposals would decrease the requirements by a small amount. These changes should be viewed as a part of a broad, careful review of capital requirements undertaken over the past 9 months. We have carefully considered the overlaps between Basel III and stress testing to ensure that when combined, capital requirements appropriately capture risk rather than being overly punitive. The resulting cumulative effect on the largest bank's capital requirements is modest. Recent changes to capital rules and accounting standards have significantly increased requirements for large U.S. banks, and they are now subject to new and generally higher requirements for potential credit losses and derivative exposures. Stress test losses also increase capital requirements, and balance sheet expansion in line with economic growth and inflation has increased GSIB surcharges. So changes to the GSIB surcharge based on underlying risk are appropriate, but increases driven mainly by real economic growth and inflation do not reflect increases in systemic risk. In addition, they're contrary to the board's long-standing commitment to update the methodology. Our capital proposals, including the 2025 stress test improvements, maintain capital requirements above the 2019 rules. The cumulative impact serves as a sensible recalibration, reflecting the recent growth of regulatory capital requirements for the largest banks. Smaller banks, which are more focused on traditional lending activities, will see slightly larger reductions in capital requirements. These changes will maintain resilience and provide flexibility to provide credit to U.S. households and businesses. So in closing, I want to note that crafting these reforms is no easy task. And over time, there have been many attempts to address some of the individual components of the framework. The proposals that will be published in the coming week will bring us closer to fulfilling the U.S. commitment to implement the 2017 Basel III agreement and will complete the first step of our comprehensive review of the capital framework. So we look forward to publishing all of these proposals and to receiving public comments. So thanks very much for the opportunity to share our proposal, or broad strokes of the proposal with you, and I look forward to answering your questions. Thanks.
Sorry. Okay. Thank you very much.
Absolutely. Thanks for the opportunity to talk about this. I might just say that we have a number of our staff who worked on the proposals here with us today, and I just want to tell them thank you for all the work that you all have done, and thank you for being here, just because I think it's a great milestone in the work that we've accomplished together and over the years that we were able to bring this proposal and its very reasonable approach to fruition. We're looking forward to next week.
That's great. Well, congratulations. And it's an enormous amount of work. We know that. And I'm sorry, don't take this the wrong way, but I don't look forward to reading it all.
It is a bit lengthy. But it's thorough, I have to say, with excellent work of our team.
That's why it's so much fun to read, too.
Why, because it's so thorough?
Yeah.
A little minutiae details.
Yes.
Yeah.
It is better than capital markets rulings, though, I have to say.
Okay.
In my humble opinion.
Well, we'll leave that to the experts on capital markets.
Yes. So I want to get an easy question out of the way up front. the proposal is going to be published in the coming week. What are we talking about in terms of the length of the comment period, and what kind of timeline do you think we're looking at to finalize everything?
Well, as I mentioned, we are looking to, I think we'll be noticing our open board meeting this afternoon. That'll be next week, and then once we have an opportunity to publish the proposal, there'll be a 90-day comment period that's built into the proposal itself. I think it will hopefully be able to implement on a relatively short time frame. I know the rest of the world has worked to accomplish their individual jurisdictions' proposals, and they've been waiting for us to get ours off the table. So we're looking forward to ensuring that we can work together to understand what the implementation timeline will be for not just for the U.S., but around the world.
Okay. So it's more complicated than...
It's more complicated, but we want to make sure that we're meeting this requirement and implementing these requirements on our banks in a time frame that makes sense for the rest of the jurisdictions.
Okay. Thank you. 90 days. 90 days. Okay, so now more real questions. So when you became vice chair, you announced that you were going to do the comprehensive review. And this is basically the end of that process, right? That's
correct.
Okay. So, and you've made really big changes now in terms of the leverage ratio, the risk-based capital requirements, the stress testing. What is your view of these changes sort of together comprehensively? Like how and why does all of this have to work together?
Well, I thank you for mentioning the capital framework day at the Fed that we had last summer. I think that was one way for us to ensure that we understood from industry and from practitioners and academics alike how we should be approaching this project and to ensure that all four of these pillars of the capital framework work together. So as we were approaching our comprehensive review, we needed to make sure we understood how each one of the components will work together to in the aggregate, create a reasonable capital framework that continued to address risk in the system, but also to make sure that they were calibrated according to the risks of the activities that are presented to the financial institutions that are conducting them. So as we were building the proposal, we didn't, as I mentioned in my remarks, we did not start from a particular level of capital. We were looking at each one of the activities on its own and to understand what the appropriate level of risk weighting should be for each of those activities. So as we've been working on the stress test proposal and working to finalize that, which we expect to be done hopefully before the end of the year, well before the end of the year. The SLR, as you mentioned, was finalized last fall. So we know what those impacts likely will be, and then they could feed into the other work that we're doing with the broader Basel III proposal and then also with the GSIB surcharge. So our hope is that with this introduction of the proposal, we'll have a very clear understanding of what capital requirements will be for the banking system as a whole. And I also mentioned that we implemented together with the other agencies, and I want to just recognize the incredible willingness of all three of our agencies with Jonathan Gould and Travis Hill over at the OCC and FDIC, and all of our staffs have worked so closely together on a very tight timeline to move forward with the interagency proposals. And I think we're all very proud of the work that we've accomplished there. But our hope is that this will be a very clear, straightforward as these complex capital proposals can be, but in a very approachable way that is clear what the impacts will be.
Okay. I should have mentioned all the regulators at the beginning too. I didn't do that. So, okay, we kind of touched on this just to go off of the stress testing idea. So that proposal was last October, right? I think.
So it's been a series of different proposals because there are different phases that have to be implemented. So
Okay.
we're currently in the process of, we've announced that we froze the SCBs at last year's levels as we're trying to finalize the model changes for for this year's stress test, so that we're not using flawed models to implement capital requirements, which are really important to get right.
Okay. All right. So that's maybe part of the answer, but because there's the overlap between the stress testing framework and the Basel III framework. Could you walk through some of the reasons for including this now, though, and then maybe just tell us a little bit about, how that informed, how those changes informed the combined sort of proposal?
Absolutely.
You kind of touched on that.
Well, it's really important that all of these components work together. So especially important is Basel III and the stress test requirements. So as we were building through the process for finalizing the changes to the stress test framework that we've been working on since last year, we wanted to make sure that we understood how they would interact, and we would no longer have overlapping or duplicative requirements. So now that we've had the opportunity to review them all in the aggregate, it was important to understand how these two proposals in particular would work together. And so we believe that we've resolved any conflicts there, but we look forward to comments. Obviously, we're very close to it, so we want to make sure we understand the industry's views and academics' views of all of our stakeholders on what they'll be reviewing in the coming week.
I'm sure there'll be lots of opinions.
I think there always are. We tried to review all of the comments that we received from the last proposal so that we could at least start from a place where we recognize the impacts and how we could address those more appropriately, calibrating them with the risk of the activities that banks engage in.
And that is how that process is supposed to work, so that's a good thing. Not.
Well, we think it's a good thing. I think it's definitely a different approach.
Yeah. See, I wasn't going to say that part, but okay, to switch gears just a little bit. In your speech, you did highlight changes that will be in the proposal about the capital framework and how it treats mortgages. Obviously, this is a relevant topic for all the housing stuff that's going on right now. For those who haven't followed that, there is a bill in the Senate. Housing affordability is a big issue. I probably didn't need to say that. So this is a relevant topic for the rule as well as for the general public. What effects do you expect these changes to have specifically on mortgage activity and or cost for mortgages or home buyers?
Well, let's start with what you just said, which is that these effects or the effects of our capital calibrations have real impacts on the economy. And I think that's the most important thing that I had in mind as we were approaching this project, is recognizing that each one of the calibrations impacts the ability of different parts of our economy to function and function efficiently and effectively. So in particular, I was a banker as we were implementing Dodd-Frank and especially the mortgage rules. And what we found, and over time as we've done more research, is that at one time 60% of mortgage originations happened within the banking system. Now that's 35%. The rest of that activity occurs outside of the regulated banking system. When we look at the statistics for mortgage origination, for servicing those originated mortgages, it used to be that banks serviced 95% of those or held them on their balance sheets. Now we have 45% of that activity on banks' balance sheets. These are traditional relationship-based activities that started in the banking system. It makes sense that we would encourage banks to return to some of those activities. I think as we were looking at the number of activities, and we all think about this in the NBFI space, and as we're trying to understand the activities and why there's been such growth in that sector of the financial system, a lot of the activity that used to occur within the regulated banking space has been pushed out based on regulatory preferences or directionally with calibrations of activities outside of that space. And this proposal will work to reverse some of that trend and allow for better risk weighting of those activities to bring it back in. In particular, mortgages is one of those areas. And I think as we were looking at more broadly, having been a community banker, those are the foundational activities that community banks offer. They're based on relationships. They understand the people that they're lending to. They can work with them if they experience economic hardship or lose a job. It's a different relationship than it is to have a very distant servicer. So I think that this is one of the motivations for some of the approaches that we've taken in these capital proposals, is that we really want to tie these activities to banks supporting the economy and to their consumers and to their businesses and directly to the regions that they serve.
Meeting the needs of their customers.
Absolutely. Oh. And the U.S. economy, right? Supporting economic activity.
Makes sense.
Yeah.
I think there's a lot of scholarship on the side of, historically, we've had financial crises that are mostly tied to real estate in some way, and the regulatory reaction is usually an overreaction, and it usually pushes some of that activity out of the banking sector. Yeah. Not speaking for anyone other than myself, I think you could probably make the case that it's happened more frequently later. With Dodd-Frank, it's at a higher rate.
Well, I think that's right. And, a lot of that reaction is reasonable in some cases. But a lot of times there were multiple approaches that if this approach didn't work, then we have this approach, we'll address them. And in many cases following Dodd-Frank, we had a belt, suspenders, and elastic waistband approach, which was that all of the approaches got implemented. And this is an opportunity for us to recalibrate and better accommodate for actual risk of the activities that got pushed into that.
Which makes sense, because usually we don't recalibrate and go back the other way. It's usually been, I think, ratcheted up, at least in my estimation.
Well, and to be fair, and I mentioned this in my speech too, that a lot of the improvements following Dodd-Frank were very important for stability and the safety of the financial system. So we're not trying to impact that at all. We want to make sure that we're maintaining resiliency and maintaining strong and robust capital requirements, but we're also calibrating them in ways that allow for recognizing actual risk instead of what we may have thought at one time in history. We've learned a lot of lessons since then, and our supervision is reflecting a lot of those lessons that we've learned, focusing on that material financial risk as well.
So it makes sense to change based on what we've learned. That's
yes, good. I agree.
Yeah. Now, you also mentioned, and maybe this is part of the same thing that we're talking about here, but you also mentioned that regional and smaller banks would see a slightly larger reduction in capital requirements.
Right.
And why is that important? Is it?
Well, again, it's to allow those banks that are not GSIBs to engage in activities that actually support consumers and business activity through lending. And so a lot of the activities that are included in that standardized approach are traditional lending activities that we want to make sure are calibrated appropriately. And with the new calibrations, we'll be able to better provide financing and support for the U.S. economy more broadly from the smaller institutions.
Okay, and now is there any concern, given what happened in 2023 with those really noticeable bank failures, is there any concern there that you'll be criticized that you're just easing requirements when you shouldn't be?
Well, let's be honest about what led to the failure of Silicon Valley Bank in 2023. A lot of that was management and supervision failures. So in addition to the work that we're doing now to refocus our supervision on material financial risk, where we had sort of taken our eye off the ball of actual financial risk in those activities or issues that could potentially lead to a bank's failure, we've engaged in independent review to actually help us understand the lessons from Silicon Valley Bank's failure, and we'll look forward to implementing those lessons once we've completed that review. But we certainly recognize that it wasn't capital or even necessarily liquidity that led to the failure of Silicon Valley Bank. I think there were a lot of steps along the way that we could have recognized that we weren't appropriately addressing, mitigating, and asking the bank to mitigate the circumstances that ultimately eventually led to the bank's failure. There were signs all throughout 2022 that told us that we were missing the ball. I think we had 40 MRAs and MRIAs that were out there that weren't related to financial risk. And when you have that many things distracting a bank's management, focusing on things that aren't related to financial risk, it's hard for them to understand how to prioritize the work that they're doing to try to address supervisory concerns. So by focusing now on material financial risk, we think that that will allow us to better communicate with financial institutions about what's important and what needs to be fixed as a priority.
And that materiality, that's been a long-standing complaint of a lot of people in the industry. I know that. And I don't think it's self-serving. Again, my own opinion.
Well, no, I think what we're trying to do is ensure that banks are in condition that don't lead to their failure, right? It's identifying early, asking for mitigation, recognizing that progress once it's been accomplished and achieved.
Perfect.
It's the basics of bank supervision.
Makes sense. Kind of staying in that ballpark, we're kind of talking about aligning capital requirements with the risk of the lending activities or traditional lending activities. Is it the idea that these changes are going to translate directly to consumers and businesses, finding it easier to get a loan? Is that the hope, or is that?
Well, what the hope is that it will free up banks to provide more opportunities to provide capital into the system. What we want to make sure is that banks retain their strong and robust underwriting capabilities. I think where you see sometimes failures in different service models or services that are provided, it's because there's been an erosion of things like credit evaluation or underwriting. So we want to make sure that those remain strong so that they really do, that the risks that we're calibrating now represent the risks based on prudent underwriting.
Okay.
Yeah, and treatment by banks.
Okay, all right. So then, and I'm going to keep going a little bit into the weeds, and then we'll stop. I won't go that deep. But the standardized approach, it's going to revise capital requirements for regional and community banks. Like, that's clear.
Correct. Although we have a parallel framework for small banks that can opt into the community bank leverage ratio.
Okay,
but yes, it does apply, but you're excluded if you opt into the CBLR.
So that's where I was going to go with this.
Oh, sorry.
No, that's okay. That's all right. You've ruined the whole thing, Michelle.
Welcome to our discussion. So, sorry.
Well, so then let's just talk a little bit about those proposals, and then if it does or doesn't touch the community bank leverage ratio, let's just do that. If we could spend a minute there.
Sure. Do you want me to explain the ratio, or how do you want to think of it?
Sure, let's do that.
Okay, so the community bank leverage ratio allows a community bank that qualifies. That means that they have a strong capital above 8% to maintain or to be excluded from risk-based requirements as long as they continue to maintain a robust level of capital at 8%. Now, just to make sure everyone understands, 8% is nearly double the well-capitalized level of a requirement for community bank capital. So we believe that this is wholly appropriate. It also extends from 2 quarters to 4 quarters. If you drop below 8% in capital, that you have 4 quarters to remedy that and get back above 8% of capital. So it's just a great way to simplify that tier 1 sort of complexity by allowing banks to opt into that framework, which is super simple. You maintain the level of capital, and then you can exclude yourself from different risk-based complexity.
More complicated stuff. Mm-hmm. And are we going to expand it? Is it?
Oh, well, what we've done is it originally was calibrated at 9% with a 2-quarter moving back to remedy. Right, so we've reproposed it as 8% with 4 quarters. So that's right. We just didn't have enough adoption.
That's okay. That's
right among the community banks, and we're hoping that this provides a more reasonable expectation. Most community banks in this country have capital well in excess of 10%. I mean, they're nowhere near 8%. So we hope that just the peace of mind of the 4 quarters of resolving, dipping below 8%, even if it might never happen for a particular institution, it might make them more comfortable to opt into a different framework.
Okay, that makes sense. I think the last time I saw data on this was about 30% take-up rate. But I think the principle, the concept is incredibly good. It's like a flat, simple ratio, and it makes it easier if you just stay there.
Right. Well, and I think early on, we applied the Basel framework and standards to all of our institutions instead of really calibrating it for the largest institutions that it was meant to apply to. So this is one way for us to ensure that the risk reflects the complexity, size, and business model of an institution with that relationship business model.
Okay. Thank you. All right. We could do one more quick question. And we did have a lot of submissions online. There's no way I was getting to everything. Let's see. Well, let me do this. GSIB surcharge, slightly different, opposite side of the community bank leverage ratio. It hasn't been reviewed since 2015.
Right.
What happened? Why wasn't it reviewed? And how are you going to ensure that it will be reviewed going forward?
Well, I think there have been several opportunities or attempts to take a closer look at it. I think part of the challenge with our first vice chair for supervision was that COVID happened in the middle of his term. So there wasn't a real opportunity to get a lot of regulatory work done because we were working on making sure that the financial system was safe and sound and resilient, and ensuring that we could implement emergency type assistance for the banking system at that time through different programs that the Congress created. It's complicated and it's challenging to get different proposals through our Federal Reserve Board because any change that we make that's through a regulation has to be voted on by our 7-member board. So different views, different approaches, and the fact that we really weren't looking at all of the requirements in their totality, and we were trying to revise different pieces at different times, so we didn't really know what the overall impact would be of calibrating a different requirement in a different way, and then addressing the other requirements in a separate, sort of independent fashion. So the approach that we're taking here, as we started with that capital seminar that we did last summer, was to ensure that we were thinking about all of these requirements together, and we weren't publishing anything without understanding the implications for the rest of the capital framework. So hopefully we've taken an approach that makes sense and that you can see it very clearly when the proposal gets published soon.
Makes sense. Okay. Well, thank you again. Thank you very much. Thank you for coming here today.
Absolutely.
We appreciate it and hope everything goes really well.
Thank you. I appreciate your time. Thanks for the hosting.